Welcome to this lesson on bonds. I'm Abhijit Jagdish from Kodkarikama. A bond is a financial asset where an investor is loaning money to a borrower. It's like a promise from a borrower to an investor that after some time they will pay back the borrowed money, and till then they will also make additional interest payments. So in bonds, the investor gets periodic payments of interest and finally the principal amount at the bond maturity time. The interest payments, start date, bond maturity date, and any other condition of the bond will be documented in an IOU. An IOU is a signed informal notice. Just like shares, one could trade bonds as well. Bonds are issued by a variety of organizations. Unlike stocks, which are mostly issued by companies, bonds could be issued by companies, municipalities, states, and governments. Like shareholders who owns share in a company, people who own bonds are called debt holders or credit holders. Interest money paid on the bond is the money investor will earn on the investment they made. This interest payout will depend on the interest rate, which is also called coupon rate. There are a variety of bonds like zero coupon bonds. In these bonds, there is no interest payment, but the issuer will issue the bond at a discounted rate of face value and will then pay the investor full face value at the time of maturity. For example, let's say an issuer is issuing a bond with a face value of $10. They will not sell this for $10. They will sell this at a discounted rate of $5. When the bond matures, the investor will get back $10. So the investor invested $5 to begin with and at maturity is getting back $10. This difference of $5 is the return on investment for the investor. Convertible bonds. Convertible bonds gives the investors an option of converting their bonds into stocks in future if they like. These bonds might look like a great investment option because on top of added security of fixed interest payments, it also gives an investor a chance to make big money if the company is successful and its stock prices go high. Callable bonds. Callable bonds are those where an issuer could call back and buy the bonds before the maturity date. Let's say a company issued a bond with an interest rate of 10%. After a few years of doing business, the reputation of this issuer has become good. They are making a lot of profit, and so a lot of investors are ready to invest in them. Now, instead of paying 10% on the already issued bonds, they could now buy these bonds back for face value and stop paying higher interest rates and then go on to issue new bonds with lesser interest rates, say 6%. Obviously, these bonds are a risky investment for investors as there are chances they will make less money than anticipated. Puttable bonds. A puttable bond allows the bondholder to put or sell the bond back to the company before it matures. This is valuable for investors who are worried that a bond value may fall in future. Great. With that, it's now time for a factual dose. The bond market is much larger than the stock market. According to some estimates, the global bond market has more than tripled in size in the last 15 years and now exceeds $100 trillion. By contrast, some sources put the value of the global stock market at only $64 trillion. In the US alone, bond market make up to $40 trillion in value compared to less than $20 trillion for domestic stock market. Trading alone in bonds also dramatically exceeds stock market volume, with nearly $700 billion of bonds traded in a single day. That compares to about $200 billion of stocks. The relative size of bond market also shows how important it is in the financial industry, even though it doesn't come up as a top priority for most common investors. Let's do a quiz now. We have so far discussed both bonds and stocks, and based on that, choose the right answers for the following questions. If you buy a company's stock, you own a part of the company, you have lent money to the company, you are liable for the company's debt, the company will return your investment with interest. Solution time. If you buy a company's stock, you own a part of the company. If you remember, we discussed in lesson 4 on stocks, each stock represents a small percentage of ownership in that company. Let's do another one here. If you buy a company's bond, you own a part of the company, you have lent money to the company, you are liable for the company's debt, you can vote on shareholder resolutions. Solution time. If you buy a company's bond, you have lent money to the company. Great. That's all we have for this lesson. We discussed these terms. Let's increment our word contour as well. In our next lesson, we shall discuss about securities, commodities, and derivatives.